Will Asian financial crisis 2.0 start from China with $9 trillion of losing bets? Experts, Chinese economic crisis has mostly limited yet remarkable impact on U.S. Chinese developer country Garden seeks grace period amid looming debt. It's all covered in today's China Truths. Will Asian financial crisis 2.0 start from China with $9 trillion of losing bets? Beijing is in dire straits. Economically, China looks like a basket case after having its growth directed for decades by an ideology of victimhood opposed to the most basic principles of market economics. The growth was based on trillions of dollars of debt that can't be paid back and could cause China's financial system to collapse, affecting most countries in Asia. An Asian Financial Crisis 2.0, AFC 2.0, starting in China instead of Thailand this time, could be coming. This is the argument in the article. Will $9 trillion worth of losing bets by the CCP cause an Asian Financial Crisis 2.0? Published August 30th, from the author Anders CORR, a principal at CORR Analytics Incorporated, and a publisher of the Journal of Political Risk. According to Mr. CORR, like the AFC 1.0, which began in Thailand in 1997, China now has a devaluing currency relative to the US dollar and a weakness in its equity and property markets. If its foreign reserves run low, it could have a balance of payments problem and a banking crisis. According to Beijing's self-reported data, which, in the case of unemployment and corporate due diligence, it is hiding, we aren't there yet. However, international investors are already acting upon the increased risk of China's contagion effects. On August 24, Morgan Stanley cut its price targets for the MSCI China Stock Index by 14% based on lower earnings and valuation expectations. The same day, Goldman Sachs warned of a spillover to other countries in Asia, except Japan, slashing price targets for Asia's MSCI ex-Japan. That included Australia, Malaysia, and Hong Kong, all of which are correlated with China. Except for a slight uptick in China's consumer sentiment that didn't even reach the low bump of April and surprisingly good net income reported by China's electric vehicle maker, BYD, the economic news from China, including deflation and slumping international trade, has been doom and gloom. The worst of them, however, are indicators that trillions worth of local government shadow bonds could become non-performing. Since the financial crisis of 2008, Beijing has allowed city and provincial governments to take $9 trillion worth of off-balance sheet debt to build bridges, roads, water plants, and flashy high-speed rail that drove eye-popping growth. That drew Beijing bragging rights, international applause, major investment to China, and the export of the model internationally under the Belt and Road Initiative. The Chinese government presented itself globally as a miracle maker that raised 800 million people out of poverty. Many around the world bought the talking point hook, line, and sinker and are still repeating it to this day. Yet in China, seniors only receive pensions of $25 to $410 per month. According to Mr. Keith Bratcher in the New York Times, public health care covers less than half of people's costs. Unemployment insurance provides around $220 a month, the U.S. average is nearly $1,700. This lack of a social safety net weighs on the Chinese consumer's confidence. The problem with China's shadow poverty and shadow debt is in the opacity of the regime and China's so-called economic growth, which, in the case of local government infrastructure projects, is largely funded by off-balance sheet debt taken by local government finance vehicles, LGFVs. These projects rarely turned a profit but did allegedly provide local officials with plenty of bribes. Beijing nevertheless allowed local shadow debt to increase for years, which caused no crisis as long as the property market was gangbusters and local government taxes could be used to pay the interest. With Beijing's attempt to limit local shadow debt in 2020, however, China's property market slumped and major developers went into crisis. Evergrande is filing for bankruptcy in the United States, and Country Gardens is near default on its first bond of as much as $2.9 billion of note obligations for the rest of this year. Local governments lost revenue from land and home sales, which, combined with unexpected pandemic expenses, made paying LGFV interest difficult. Bond payments are still being made, but cracks are starting to show in the servicing of shorter-term debt. Last year, about half of the cities in China were making interest payments only with difficulty. If LGFVs default on their bonds, the first to feel the pain will be investors in China. According to Bloomberg, all types of financial institutions have exposure to them: commercial banks via their wealth management units, insurers, mutual funds, securities companies, and hedge funds. The overwhelming majority of their investors are local, as foreigners consider LGFVs to be opaque and hard to analyze. But as noted by Goldman Sachs, international investors also have worries, especially those in Asia whose economies are closely tied to China. According to Bloomberg on August 23, any default on LGFV's $2 trillion of bonds, which account for nearly half the country's onshore corporate debt market, would destabilize China's $60 trillion financial system, producing global shockwaves. Thai economists are warning that the Evergrande collapse alone is hitting Thailand's construction material exports and tourism revenues hard. Thailand's biggest export market and source of tourists is China. Beijing has responded by allowing provinces to adopt some of the debt onto their balance sheets. That could provide solace to markets by decreasing the risk of shadow defaults and contagion. Some investors, including internationally, are calling for more government stimulus. They threaten not to return to China if the government doesn't cough up more subsidies. However, subsidies that failed because they did not follow market principles were the cause of China's economic problems in the first place. These investors want short-term profit. They don't care about China's long-term economic strength, which can only be based on increased political and market freedoms rather than more communist-directed subsidies. In the long run, freedom, rather than dictatorship, slavery, communism, taxes, and subsidies, will create international trade and strong economics to boost the shockingly low standards of living in China. The tangible benefits of freedom are the lessons that the thriving economies of the United States, Europe, Japan, South Korea, Taiwan, and a free Hong Kong, may it rest in peace, have for China. With freedom comes prosperity. Experts, Chinese economic crisis has mostly limited yet remarkable impact on U.S. Murphy's Law seems to be playing out for China's economy: anything that can go wrong goes wrong. For the past 5 months, bad news broke one after another, exposing structural issues in real estate developers and local government solvency, tied down by an ailing property sector that grew to be over a quarter of China's GDP. Exports, the other growth engine for the Chinese economy, have also seen an accelerating year-on-year decline since March. In addition, experts say China's aging population and low consumer confidence point to a decade of economic stagnation, with a real risk of a growth rate barely above zero. How much will a Chinese economic slowdown affect the United States? Experts' consensus is that the impact is limited. Mr. George Magnus, an associate at Oxford University's China Center and a former chief economist at UBS, said, "The global repercussions of China's economic travails are mostly limited but still remarkable." He continued, "Limited because I don't see financial market contagion coming from China unless Beijing lets the yuan sink like a stone, which it won't," adding that other than commodity exporters, the world's exposure to Chinese real estate is not much. Mr. Brad Setzer, a senior fellow at the Council of Foreign Relations, agrees that the main channel where China's slowdown will affect the United States is through exchange rates. He estimates that a 10% depreciation of the yuan, or a 10% decrease in the real exchange rate, a net effect of nominal exchange rate and price differences between two currencies, to the dollar, will drag down the U.S. GDP by 0.5%. According to the Bank for International Settlements, known as the Central Bank for Central Banks, the real exchange rate of the yuan has depreciated by about 8% between January and July. In Mr. Magnus' view, the remarkable side of the impact includes a weaker Chinese economy's subtraction on global economic growth due to lower imports and potentially greater international relations truculence by the Chinese regime, leading to heightened global tensions over Taiwan or the South China Sea. Limited impact. The channels of a Chinese economic impact are from the overlapping areas of two economies, the financial market and import-exports. Economist Paul Krugman estimates the total U.S. direct and portfolio investment in China at slightly over $500 billion. By comparing that number to the U.S. office buildings valued at about 5 times as much at $2.6 trillion, he illustrated the scale of U.S. exposure to a potential Chinese economic crisis as surprisingly small. The overall impact on exports is also modest. The U.S. exposure to China's real estate market is little because it doesn't export a lot of copper, iron ore, or other commodities to Chinese construction firms. According to the Bureau of Industry and Security, BIS, under the Commerce Department, in 2022, U.S. exports to China totaled $153.8 billion, about 7.5% of the total $2.1 trillion U.S. exports to the world. The same document reported U.S. copper, iron, and steel exports to China at about $4.5 billion in 2022, or 3% of the total exports to China. However, the U.S. agricultural exporters, especially farmers of soybeans, which accounted for nearly half of the U.S. agricultural exports to China last year at $16.4 billion, will feel the repercussions of China's weakened demand. Mr. Setzer said, the economy as a whole doesn't export that much to China, noting that the story differs for a few particular sectors. So if you do a standard estimate of the impact between a China that grows at 5% and a China that doesn't grow, you don't get a really big aggregate impact on U.S. exports. He added that China's banks don't borrow much from the world, they mainly raise and lend money inside China. Therefore, losses in China's banks are an issue for China, not the world. Countering U.S. inflation. China's slowing growth means lower import costs and consumer goods prices for the United States. Mr. Edward Yardeni, president of Yardeni Research, a global investment consultancy in New York, observed that the Chinese Producer Price Index, PPI, an inflation measure from producers' perspective, tends to be a leading indicator for the same index in the United States. In July, China officially slid into deflation with a negative year-on-year consumer price index, CPI, and factory gate prices, or PPI, showed year-on-year declines for the 10th consecutive month. Mr. Yardeni said, if China has deflation, then that may allow us to have inflation come down without a recession in the United States, adding that some of the impact has shown up in reduced U.S. retail prices and PPI prices. The U.S. core inflation, which is the overall CPI less food and energy, has dropped from 6.6% in September to 4.7% in July. PPI for goods, excluding services, has come down from the height of 1.3% in January to 0.1% in July, with negatives in 3 months in between. Mr. Yardeni added, so in that sense, the pain in China's economy is a gain for the U.S. economy, in the sense that we don't need to have a recession to have inflation come down. Supply chain implications. Mr. Setzer thinks lower import costs from China may lead to more reliance on China. He added, it mitigates the effect some of the Inflation Reduction Act is trying to reduce U.S. dependence on China in specific sectors. A weaker Chinese currency encourages the U.S. to rely more on Chinese supply, directly and indirectly, in all the sectors that don't benefit from the specific provisions of the Inflation Reduction Act. Even though U.S. imports from China reduced from 21.6% of total imports in 2016 to 16.5% at $536.8 billion in 2022, the United States still sources indirectly from China via other parts of the world. Therefore, to Mr. Setzer, unlike a Chinese economic slowdown, a U.S.-China decoupling is still a shock beyond normal adjustments for the U.S. economy. However, Christopher Balding, an expert on the Chinese economy at the Henry Jackson Society, a UK-based think tank, thinks that a China slowdown's limited impact on the U.S. economy indicates that a U.S.-China decoupling isn't going to be disastrous. He said, "I am not saying it would be painless or no adjustments needed, but it's not at all the major earth-shattering event many have described." Yes, a slowdown and decoupling are different issues. But if slowdown will have very little impact, then decoupling would have minimal impact. In his view, the goods the United States imports from China are either those that can be easily sourced from other countries, for example, t-shirts, or those that need to move at least partially to other countries, such as semiconductors and electronics. And the reason for people to have the impression that a US-China decoupling will be earth-shattering? Mr. Balding said it might be that people wanted to be chosen to be rich by the Chinese Communist Party, CCP. The CCP does a great job of giving everyone just enough candy so they always want more and always think that China will reform and let them in even though they never do, so everyone keeps expecting it, he said. But the reality is the US and Chinese economies really aren't intertwined enough to cause major issues if China has economic problems. Chinese developer Country Garden seeks grace period amid looming debt. Country Garden Holdings, China's largest property developer, has reportedly sought a 40-day grace period to repay maturing bonds due on September 2 as the company approaches the verge of default. The embattled developer is also seeking its creditors' approval to extend the repayment of 3.9 billion yuan, about $535 million, private onshore bond by 3 years, according to the documents seen by Reuters. Creditors are expected to vote on the new plan on August 31. The company added a new voting item for an additional 40-day grace period in the document received by private bondholders on August 29. Country Garden was once known for its large-scale projects in smaller cities and rural areas, as well as its ambitious plans to build a forest city in Malaysia. However, the company has been hit hard by Beijing's tightening measures on the property sector, which aim to curb speculation and debt risks. The company has also faced increasing competition from other developers, such as Evergrande Group and Sunac China Holdings Ltd. The developer earlier this month missed $2 coupon payments totaling $22.5 million, fueling fears that the country's property debt crisis could hamper a broader economic recovery and spill overseas. Forest City project in Malaysia. The debt crisis also raised questions about Country Garden's ability to complete a $100 billion Forest City project, its largest overseas development in the southern Malaysian state of Johor bordering Singapore. Country Garden said on August 28 that the Forest City project is operating normally with strong sales performance, assuring that its overall operation in Malaysia remains safe and stable despite the debt crisis. The developer told reporters, various debt management measures are considered to actively resolve the pressure of periodic liquidity to ensure the company's long-term future development. According to the project's website, Forest City is a joint venture between Country Garden, 60%, and Esplanade Danga 88, 40%, a private Malaysian company backed by the Johor government and the Sultan of Johor. Malaysian Prime Minister Anwar Ibrahim said that his government would designate the project as special financial zone, lowering the cost of doing business there in an effort to boost the local economy. The zone designation will include incentives like a flat income tax rate of 15%, multiple entry visas, and fast clearance for skilled workers commuting between Malaysia and Singapore. According to The Star, Mr. Anwar said at a nationwide tour of the Budget 2024 on August 28, "I am confident this will attract many companies that are experiencing high operating costs in Singapore." The project aims to house 700,000 people by 2035 in a development that includes office towers, malls, schools, and residential buildings. Don't forget to comment in the section below to share your opinions on today's topic with us. Make sure to like and subscribe to see more interesting topics from China Truths.